China has recently taken an unexpected step in the trade war, causing major shocks to the U.S. economy. Will this new strategy lead to a global crisis? China has canceled all orders for 2.4 million tons of soybeans, worth $1.1 billion, while shipments were in transit, redirecting its purchases to Brazil. As a result, U.S. soybean stocks increased by 13%, reaching their highest level since 2019. Meanwhile, soybean prices dropped by 8.2% on the Chicago Exchange, leading to a loss of approximately $470 million in just 1 week. Farmers in the Midwest are facing the risk of reduced income and contract defaults, while consumers may see an increase in food prices, particularly for soybean-based products. China has shifted its purchase of 2.4 million tons of soybeans from the U.S. to Brazil. As a result, Brazil now meets about 70% of China's soybean demand, thanks to substantial investments in infrastructure, including $11.2 billion, allocated for ports and transport systems 2020-2024. Meanwhile, U.S. agricultural exports to China dropped by 26% in Q1 2025, equivalent to $3.2 billion. And U.S. corn exports decreased by 29% as China signed a 3-year corn import contract with Brazil. This shift not only reduces U.S. farmers' revenue, but also drives up food prices due to the reduced supply of agricultural products from the U.S. directly affecting consumers' living costs. China has employed non-tariff tactics by imposing barriers on U.S. agricultural exports, citing quality concerns, mold pesticides despite the lack of specific evidence from the USDA or WTO. This move is intended to destabilize U.S. exporters, while also serving as a political lever to pressure rural voters and agricultural states that support Trump, thus challenging the U.S.'s ability to maintain its supply chains. This has created uncertainty in export contracts, making it difficult for U.S. farmers and businesses to forecast and maintain long-term agreements. This instability not only reduces U.S. farmers' income, but may also impact food prices in the U.S. and international markets as producers struggle to maintain product quality, and pricing. Businesses also face challenges in sustaining long-term contracts and dealing with higher production costs. China has canceled soybean orders worth $1.1 billion within 72 hours. This could serve as a test run for other critical commodities, such as semiconductors, rare earth materials, U.S. Treasury bonds, and even the U.S. dollar. If this strategy proves successful, China could apply similar tactics to other sectors, exerting significant pressure on U.S. supply chains and the economy. China's ability to replace major supplies from the U.S. would increase the risk of higher production costs and supply shortages, leaving U.S. businesses struggling to maintain production and facing higher expenses. Consumers would feel the impact through rising prices for consumer goods, particularly in industries such as electronics, automobiles, and other everyday items. The United States and Mexico are facing an unprecedented trade crisis, disrupting the global automotive supply chain. Will this move lead to significant consequences for the economy and consumers? On April 3, 2025, the U.S. imposed a 25% tariff on automobiles and components from Mexico, leading to a 40% drop in cross-border trade and a $100 million disruption in goods within just 24 hours. Trucks carrying parts were delayed, affecting production. Stellantis had to shut down its plant in Toluca, Mexico, resulting in 900 U.S. workers losing their jobs. The cost of each vehicle in the U.S. increased by an additional $4,800 to $5,000, raising car prices and creating difficulties for both consumers and workers. These disruptions have strained the supply chain and directly impacted everyday life. Manufacturers are struggling to maintain production, and workers at the factories face the risk of job loss. The U.S. and Mexico not only trade goods, but also co-produce automobiles. A single vehicle can cross the border 20 to 30 times before the final product is completed. Key components such as engines, transmissions, and electronic parts may be produced in different countries and then transported back and forth across the border for assembly. However, the U.S. tariffs on goods from Mexico have caused significant disruptions in this supply chain. Automakers such as Nissan have had to withdraw 2 SUV models from the U.S. market due to the high tariff costs, making sales unfeasible. Additionally, major parts suppliers like Novarez and Valeo are demanding upfront cash payments to continue shipping crucial components across the border. As a result, not only is the U.S. auto industry suffering, but Mexico's automotive sector is also heavily impacted. Many workers in assembly plants and component manufacturing may face job losses, and companies are struggling to maintain production and fulfill contracts with customers. While Mexico's President Claudia Sheinbaum publicly responded with a measured tone, the country has deployed a Plan B of selective retaliation, targeting U.S. sectors such as agriculture, steel, pork, and dairy, industries with significant political influence. Mexico has also drawn lessons from 2010, when retaliatory tariffs caused the U.S. to lose $2 billion in exports over the course of a year. At the same time, Mexico is negotiating to strengthen trade partnerships with Canada, the EU, Brazil, and Japan to reduce its reliance on the U.S. Volvo has announced plans to expand production in Nuevo León, Mexico, emphasizing that the country remains a stable and efficient manufacturing hub. 8 million jobs in the U.S. depend on trade with Mexico and are now under threat. In key battleground states like Michigan, Wisconsin, and Pennsylvania, workers who have lost their jobs are shifting from support to anger, causing political instability. Meanwhile, the U.S. dollar has dropped to its lowest point in 3 years, with inflation expected to peak at a 40-year high. Trust in the USMCA is wavering as major companies plan to move production out of North America, seeking opportunities in Asia and Europe. Businesses are looking for lower-cost manufacturing environments less affected by trade barriers. With changes in tax and trade policies, companies feel that maintaining operations in North America, especially under the USMCA framework, is no longer as economically advantageous as it once was. China and its strategic move to challenge the dominance of the US dollar. No SWIFT, no USD. China is reshaping the way the world pays. Is the global position of the US dollar under threat? By the first quarter of 2025, China had processed over 18 trillion yuan, approximately 250 billion USD, in cross-border transactions using the digital yuan ECNY. This system is directly integrated with CIPS, which now connects more than 1,400 financial institutions across 110 countries, enabling fast, low-cost transactions without relying on SWIFT. The ECNY enables near-instant and virtually cost-free transactions. This advancement helps businesses reduce operational costs and shortens payment times. While individuals benefit from more convenient international money transfers for migrant workers in particular, the ability to send money home faster and at lower fees can make a tangible difference. Less money lost to fees each month and near-instant access to funds. This, in turn, can improve household spending and reduce reliance on traditional financial services. Moreover, those without a bank account can still participate in the financial system through the ECNY wallet, broadening financial access and inclusion. By the end of 2024, China had signed more than 40 bilateral currency swap agreements, with a total value of 586 billion USD. These agreements not only strengthen financial cooperation, but also improve access to financial services in countries with limited banking infrastructure, reducing reliance on physical cash and exposure to USD exchange rate. Volatility. The share of China's cross-border transactions conducted in yuan rose from 40% in 2021 to 53% in 2024. Within the ASEAN bloc alone, transaction value reached 5.8 trillion yuan in 2024. an increase of 120% compared to 3 years prior. For businesses, this shift lowers currency conversion costs and helps stabilize exchange rates for individuals. It contributes to curbing imported inflation and helps keep the prices of essential goods more stable. The digital yuan ECNY is also being used in Belt and Road Initiative projects, such as the Gwadar port in Pakistan and the railway in Laos, where it enables direct payments and capital oversight through smart contracts. Local workers receive wages via ECNY, allowing for faster, transparent, and intermediary-free payments, supporting higher earnings and reducing leakage. Currently, 13 BRI countries are piloting the use of ECNY. The rollout of the digital yuan, ECNY, is playing a growing role in reshaping the global financial system, especially as Beijing moves to expand the use of the yuan in international trade, following the United States' decision in April 2025 to impose a 145% tariff on Chinese goods. As of March 2025, the cross-border payment system based on ECNY had been connected with 10 ASEAN countries and 6 Middle Eastern nations. This network enables faster transactions, lower costs, and eliminates the need to route payments through SWIFT. According to the Bank for International Settlements, BIS, the use of central bank digital currencies such as the ECNY could reduce international transaction costs by 5 to 7% compared to traditional banking systems. The BIS also notes that access to financial services could increase by 4 to 6% in developing countries with effective digital payment systems. This shift not only helps partner countries reduce their dependency on the US dollar, but also supports more stable commodity prices, thanks to lower transaction costs and reduced exchange rate volatility. For everyday citizens, particularly in developing nations, faster and cheaper access to financial services can lead to improved daily living conditions, lower costs, and expanded business opportunities. Car prices are rising, jobs are gradually disappearing, and Americans are struggling in the midst of a shifting economic landscape. What is happening to the auto industry, once the pride of the United States? Tariffs and protectionist trade policies have driven production costs sharply higher, pushing the price of American-made vehicles to record levels. According to Edmunds, by early 2025, the average price of a new car has surpassed $50,000 USD, while used vehicles are nearing $32,000 USD. With incomes failing to keep pace, many consumers are left with no choice but to hold on to older cars, even as maintenance costs continue to rise. Cox Automotive reports that a standard oil change, once around $50 USD, now exceeds $100 USD. Hourly wage earners and those on fixed incomes are bearing the brunt of this burden, particularly as broader living costs, from groceries to gasoline, rise in tandem with the new wave of tariffs. McKinsey notes that 75% of American consumers have shifted to buying cheaper goods, primarily food, due to tightening household budgets. At the same time, unemployment is spreading. The manufacturing sector is seeing a jobless rate of 5.2%. Construction has shed 34,000 jobs, and agriculture has experienced a 3.8% reduction in its workforce. These losses stem from rising raw material costs, declining export demand, and widespread order cancellations, all of which are forcing families to cut back on spending, weakening purchasing power across the broader economy. As American car prices rise and deliveries slow due to parts shortages, Japanese and Korean automakers are gaining ground, thanks to competitive pricing and more agile supply chains. In 2024, Toyota captured 12.5% of the U.S. market. Hyundai Kia held 10.2%, and Honda accounted for 8.1%. These vehicles are known for their durability and fuel efficiency, qualities especially valued amid the steep increase in fuel prices, driven by new import tariffs. Hyundai has announced plans to invest $21 billion USD by 2028 to build electric vehicle and steel manufacturing facilities, expected to create an additional 100,000 jobs and stimulate regional economies. In contrast, many American automakers have been forced to scale back production due to rising costs, leading to widespread layoffs. This has reduced consumer access to domestic models, while further pushing up the price of American-made cars. The shift toward Japanese and Korean vehicles also reflects a broader trend, a trend toward more frugal consumer behavior. With U.S. economic growth projected to slow to 1.4% in 2025, down from 2.2% previously, according to McKinsey, many Americans are adjusting their spending habits in anticipation of leaner times. The 25% import tariff has driven up car prices by an average of 13.5%, or roughly $6,400 USD per new vehicle. This price spike not only strains consumers, but also directly affects manufacturing and exports. Ford has halted exports of the F-150, Mustang, and Bronco to China in response to retaliatory tariffs of 150%. Stellantis has laid off 900 workers across 5 plants, while Volvo has announced job cuts ranging from 550 to 800 positions. Current trade policies are weakening the U.S. auto industry, leading to declining revenues, job losses, and reduced access to domestic vehicles for American consumers. Without timely adjustments, U.S. market share for American-made cars could fall below 40% within the next 5 years. The inflationary pressure driven by tariffs is also spreading to other sectors. In agriculture, the unemployment rate surged to 12% in March 2025, the highest in years. This reflects the broader, cascading impacts on the overall economy and the daily lives of millions of Americans. As the U.S. and China continue their fierce trade rivalry, the question remains: who is truly paying the price? The forthcoming changes are expected to have a profound impact on American households. Amid escalating trade tensions, China has officially imposed a ban on domestic airlines purchasing aircraft from Boeing, including the 737 MAX and 747 models. This move directly affects major airlines such as Air China, China Eastern, and China Southern, who have been significant customers for Boeing. Boeing, currently grappling with both technical and financial challenges, reported a loss of $11.8 billion in 2024, and its stock has dropped by 12% since the start of 2025. Boeing is also one of the largest employers in the U.S., providing direct and indirect jobs for tens of thousands of workers in fields such as supply chains, maintenance, logistics, and services. Losing the Chinese market, which accounts for more than 15% of Boeing's international sales, may force the company to scale back production, leading to potential layoffs or reduced working hours. China represents about 15% of the global commercial aviation market and is projected to increase this share to 20% within the next 15 years. In addition to halting aircraft imports, China has also suspended the import of aviation parts from American companies. This will have a ripple effect on thousands of suppliers, such as GE and Spirit AeroSystems, impacting factories across various U.S. states, including Washington, South Carolina, Kansas, and Missouri. As Boeing faces a decline in revenue, tax revenue from businesses in these states is expected to drop, which could lead to cuts in public spending, directly affecting social services, education, and healthcare that American citizens rely on. On April 11, 2025, China officially imposed a 125% tariff on all goods imported from the U.S., including agricultural, industrial, and pharmaceutical products. This move has significant implications for U.S. businesses, particularly in the pharmaceutical sector. Companies such as Eli Lilly and GSK are facing higher costs for their cancer and diabetes treatments made in the U.S., with limited access to the Chinese market. This increase in costs may make it more difficult for U.S. companies to maintain affordable prices domestically, thus impacting American healthcare costs. Along with the tariffs, China has suspended exports of rare earth materials and magnets, critical components in the production of electric vehicles, chips, semiconductors, aviation, and defense. This disruption will likely drive up the cost of products such as electric cars, laptops, and smartphones. U.S. consumers will either face higher prices or longer wait times for these items. Agricultural exports such as soybeans, beef, and grains are also heavily taxed, leading to significant losses for American farmers. Many could see their income decline, lose their farms, or be forced to apply for government subsidies. Following the suspension of Boeing aircraft imports, China has deepened its partnership with Airbus. Airbus now operates an assembly plant for the A320 series in Tianjin and is expanding its production line, with plans to increase output to 75 aircraft per month. By 2026, China has already placed an order for 150 A320 Neo aircraft and 10 A350SS from Airbus. China is also heavily investing in COMAC, Commercial Aircraft Corporation of China, a domestic aircraft manufacturer. COMAC has increased its production of the C919 aircraft from 50 to 75 per year, with a target of 200 units annually by 2029. In addition to strengthening its aviation industry, China is pushing for increased use of the Chinese yuan, CNY, and the euro in international trade, particularly in the aviation sector. As more nations shift to trading in either the euro or the yuan, demand for the US dollar decreases, weakening the dollar. This will lead to higher import costs for Americans purchasing goods like clothing, electronics, and cars, thereby driving up domestic prices.